meant for recommendations, and you should not take this as a financial advice, but just an opinion. Okay, and if you can take away some of the lessons learned, I think that would be the objective of this session itself. So let's start with, what do I mean by high quality REITs? So just understand that not all REITs are of equal quality, and there are some REITs that are better than the others. And how then do we know one REIT is of a high quality? And of course, if you ask different investors, you might get different kind of answers. But to me, I think one of the key things that I would really want to qualify a REIT is based on its track record. And the track record involves the consistent rising distribution per unit, okay, or DPU in short, or in layman term means this dividends. Okay, so you do want to see a REIT has a track record of increasing its distribution per unit each year. Whether is it recession, whether is it a booming economy, whether is it high inflation, high interest rate environment, you do want to see the REITs are able to increase their dividend every single year. Okay, so that is my very simple definition of what a high quality REIT should be. And although it sounds like just one criteria, so what about it, right? But to be able to really raise dividend every single year is not easy, okay? Because it is an indirect kind of a signal that the REIT has great properties, okay? Because only you have great properties, your tenants will not run away when you increase the rent, okay? Because it does provide certain unique benefits to the tenants. And it also shows that the management is good, right? Whether is it that acquire you accretive kind of properties, or they are they're able to manage a property in such a way that they can improve via the asset enhancement initiatives, all these kind of things, keep them in good shape, and that's why they are able to raise rent and extract more value out of the property itself. So all this must come together in order for this consistent rising distribution per unit to happen. Okay, and there are not many REITs that can pass this simple criteria, and I'll show you 7 of them later. And the other thing is that, as I mentioned just now, we are in a rising interest rate environment, and tonight the Federal Reserve is going to probably announce how much rate hike is going to be, and the market believes that it's going to be about 0.25% rate hike, which is lower than what 0.75% kind of standard in the past few raises. Okay, so it is kind of a good news for REITs, and that's why you see for the past 1 month REITs have been running up pretty much for across the board, okay, which is a good sign, right? Because this interest rate has been a very big impact to REITs, because REITs are essentially leverage kind of instrument where they borrow money to buy properties. Okay, so rising interest rate do hurt them to a certain extent. And lastly, there is an advantage of buying this kind of high quality REITs, because you don't just get rising dividends, you don't just get more dividends as years goes by, you also get capital gains, okay, very likely, because in order for them to give higher dividend or higher use over the years, or increase their distribution per unit, that also mean that their value of the properties would likely increase, okay, and with that will come higher REIT prices, and that's where you get your capital gain as well. So you get best of both worlds, and their use may not be the highest, but they do compensate with very good capital gains over the years. I will show you other examples later. So the very first one that we're going to share is this company called Mapletree Pan Asia Commercial Trust, or N2IU, listed in the Singapore Exchange. And the distribution per unit, you can see that it has been compounding for about 6% per year. Okay, you can see there's a dip in 2019, all right, but then it quickly regained in 2020 and 2021. And in fact, those 2 years are the COVID years, and yet they were still able to increase the distribution per unit. So give and take 1 year, I think is fine, right? Over a longer track record that is displayed over here. And there is a very consistent growth of about 6% per year over the period that we're looking at. And this is the latest result based on 31st December 2022. And you can see that basically what I want to show you here is the composition or the geographical diversification of their properties, right? Main bulk of the properties are still in Singapore, right? About 68%. That makes up of if some of you are based in Singapore, you know, like Vivo City, MBA, the Marina, the Marina Bay Center, all this, they have a stake in them, right? So which are very prestigious properties. Okay. So this is the composition, and you can see that there are some overseas properties, and the overseas properties were mainly because of a merger with a sister Mapletree REIT previously. So now it become a much bigger REIT as compared to the past, right? But the core assets are still based mainly in Singapore. And the other thing that I want to share with you is which we will go through quite a number of them as we go through the REITs today, is also to look at their debt. Okay, because the debt profile, because as I said, interest rate is rising, and we need to watch this area carefully, right? Not just raising the distribution per unit, because if they are over geared or they are paying a much higher interest rate than market rate, then it will really hurt this kind of REITs. They may not be able to raise the dividends in the future. So given that I believe higher interest rate is going to be likely the new normal for quite a while, I don't expect interest rate cuts. Although the market believe that second half of this year is likely to get cut, as indicated by the yield markets right now. But I'm really not sure. Okay, if they don't raise rate in the second half of 2023, I think it's already a very good news. It will give a lot of stability to investors, not just REIT investor, but also for growth investors, where now, you know, using a discounted cash flow, the discounting rate can be a lot more stable as compared to the past 1 year, where it's been raising every meeting, the FOMC meeting. Okay, so this Mapletree Pan Asia Commercial Trust, we can see the gearing is at 40.2%, and the limit in Singapore is 50%, right? So there is still a bit of debt headroom to go. They are not overly geared, right? And so this is not a big concern. And the interest rate did increase, but it's still at 2.57%. I think this rate is quite low for a property borrower, right? I think even if you are individual, you try to borrow, you won't get this kind of rate. And moreover, almost 80% of these rates are fixed. So even with higher interest rate, it should not impact this rate that much. And the debt maturity is about 2.8 years. More accurately, we want to see this is the chart to show the debt maturity, right? Every year, how much amount of debt is due. And usually for REITs, when the debt is due, they will refinance. Okay, they refinance, extend the loan further. And of course, if rates continue to increase, the future renewal or future refinancing of this debt will keep increasing in terms of its interest rate. But if you ask me, I think we are already at probably the peak interest rate. We are very close to likely the 5% peak interest rate this year. Okay, I don't think it should go beyond that. And second half of the year, they may stay stagnant or even get cut. Okay, so if that's the case, I think in the future years, it should not see that aggressive rate hikes anymore. So all this refinancing, I don't think you'll be at higher interest rate in the foreseeable future. So I do think that that's a good sign, right? So it's not a very big concern for this MPACT. Okay, and the other thing that I want to point out, right, when you look at this debt profile, you also do not want a sudden spike in the debt expiry, right? In this case, it's quite evenly spread out. Okay, most of the debt will expire between 2024 and 2027, okay, within that 4 years, right? So it's quite evenly distributed. So with that, you will not have a sudden interest rate risk for that year if you happen to have a very big spike in the need for refinancing the debt. Okay, so in this case, the debt profile looks quite regular. And this is the share price, right, between 2013 to end of last year. You can see that the 10-year return was about 135%, or annual return of 8.9%. This is inclusive of the dividend gains as well. Okay, so it's dividend plus capital gain. You get about 8.9% per year. Okay, so that is the profile, right? So that's why I say that it's not just that you get the dividend, you also get a capital gain as the REIT increases its distribution per unit over the years. Second one, another Mapletree sister company right? So this is Mapletree Industrial. It is not in the commercial space, right? So for Mapletree Pan Asia Trust, that is more of malls, a lot of shopping malls, mainly in Singapore. But this Mapletree Industrial is, of course, as the name suggests, is focused more on the industrial property units. And same thing, you can see that the distribution per unit has been very consistent, rising every single year in the past 10 years, okay, on a compounded growth of about 5% per year. Even during COVID, you can see they continue to raise distribution per unit. This is not easy to achieve. You can go and see, especially the hospitality trust, totally bombed during the COVID period. Okay, but the industry was still going strong because especially the logistics sites, they were still using the warehouses. Companies were still producing stuff, right? Especially important essential products. So this is the type of industrial properties that Mapletree Industrial portfolio consists of. And you can see that there are high-tech buildings, about 17%, business park, 6.5%. Flattened factories are probably the most rudimentary kind of industrial properties, 16.7%. Stack-up ramp-up building, 5.6%. Light industry building is a very small number. And the data center is the new big composition in the Mapletree Industrial portfolio. Previously, data center is a very, very small percentage, okay? Because they do see that for the industrial space, data center is the most premium, and it is a fast-growing space around the world, right? Because with the increasing need for more bandwidth, a lot more data transfer, right? You and me watch a lot of videos, probably like what we are doing now with the webinar. There is a lot of data that needs to be transferred from one server to another server and to your phone, right? Or to your laptop or your tablet. So there is a lot of this data consumption, and you definitely need this to house all this server properly, because data center, you cannot just find any building and just park your servers there. They need to be near the subsea cables. They need to be connected to the network, the grid itself. And the building also has a specification, right? Because they're known as an energy guzzler. They produce a lot of heat. The cooling must be right, otherwise the server may get overheat and spoil. Okay, so these are considered specialized properties, but still fall under the industrial kind of definition. Okay, so data center, they see it as a new growth area, and that's why they went to acquire a lot of all these data centers, especially in the United States. So in terms of geography, because of the big investment in US, now it's about half-half, right? Half in North America, half in Singapore. Okay, so just understand that most of the data center are based in US, right? So the other half of it, the normal or the various type of industrial properties, are actually based in Singapore. So this is the debt profile for Mapletree Industrial, right? Gearing ratio is below 40%, very healthy. Interest rate is higher than what we saw with the Mapletree Commercial Trust, right? It's at 3.3%. For Mapletree Commercial, it was sub 3%. Okay, so this is generally a bit higher because for industrial property, their lease tend to be shorter. Quality of the property is not considered as good as, say, the malls and office. So it could be the case why the interest rate they pay is higher. And also because of the exposure to US, right? Because for US, the interest rate is higher as compared to those in Singapore. So that could also be one reason why when they borrow the US dollar, the interest rate were higher as well. Okay, so there can be a myriad of reasons for that. And in terms of percentage of debt that are fixed is at 74%, which is also quite healthy, right? Because which means they are quite immune to further interest rate and hikes. Only that 25% that's variable. Okay, otherwise majority of them are pretty much fixed. And those of that profile is even better because the debt expiring majority of them are expiring in 2027 to 2028. Okay, that 2 years. So my view is that the further you go, the higher chances you might experience a rate cut, okay, rather than a rate hike. Okay, so if you have a lot of debt due now, then it's not a good news because the interest rate now is a lot higher. Okay, I do think that as time goes by, the chances of rate cuts are higher. If just within these few years, then the chances of rate cuts are lower. Okay, so for Mapletree Industrial, that is one of the advantages that we can see in the debt profile. So past 10 years, it has gone up 200% or 11.7% per year. Okay, so I do think that the foray into the data center really did improve the investors' perception of this REIT itself. The third one is ParkwayLife REIT. Okay, so this is a hospital REIT, which is very different from many other REITs out there. And one of the benefits of a hospital REIT, right, is that usually the lease is very long, like 30 years, those kind of numbers. You're counting in terms of decades, not like commercial, industrial, you're talking about 2-3 years kind of lease renewal. For hospital is very high. Okay, very large number. And you can see the track record has been good, right? 3% compounded annual return, annual increase in the distribution per unit. Okay, so the gains are a lot higher, which I'll show you later. So you can see there's some peaks or some spikes over here. That's because of special dividends, right? So that makes that height higher, but actually every year they've been consistently increasing the ordinary distribution per unit. Okay, so for ParkwayLife REIT, majority of their hospital assets are in Singapore. Okay, we are looking at very big names like Gleneagles, Parkway East, Mount E. These are private hospitals in Singapore. They're considered the top end. And they, if touch wood, if anybody warded them, it's definitely one of the most expensive beds you can pay for in Singapore. Okay, so that's how they have positioned themselves very well, right? So the parent company actually lease from this REIT. Okay, so the parent company is the hospital operator themselves, right? So they pay the rent to this REIT itself, and they also get a share of some of the good performance. If the hospital do well, they actually take a cut of their profits. Okay, so that is also another advantage of this REIT itself. And the other good part of the portfolio is in nursing home. About 34% of the property portfolio is in nursing home in Japan. Okay, and we all know that Japan has this aging issue, and the need for nursing home has been rising and will continue to rise for a foreseeable future. And that is also a very good position to be in. So they are also having a good exposure to nursing home in Japan as well. And in terms of debt profile, pretty much balanced, healthy, I would say. Gearing ratio not high with a lot of debt room, 36%. Interest rate is super low, okay, 0.53%. Even though it's not the latest quarter results, I didn't manage to find it, but the previous quarter was 0.53%. It's the lowest I've seen among all the REITs. I suspect there could be, again, a few reasons, right? One is they are borrowing in yen. Okay, and yen, the interest rate is a lot lower as compared to Sing dollar per se. And the second reason is hospital assets, right? The lease is very long, okay, which the risk of these hospital assets are even lower. So based on the risk assessment, they might be accorded a lower interest from the banks as well. And this is a debt profile, right? So they have some debt due between 2024 and 2017. Okay, but it's not a big spike, just 20% of the debt. Okay, so it's quite well spread out as well. Okay, so I do think that the interest rate risk is not as high for ParkwayLife REIT in this case too. Okay, in terms of share price performance, very fantastic, 168% in the last 10 years, looking at about 10% per year. Again, this is inclusive of dividend gains as well as capital gain. Okay, it is not the latest, it's based on December last year, right? If we take the run in the recent 1 month in January, the returns will even be higher, right? Because you can see there's a very steep correction. And even with this steep correction, the 10-year return is about 10% per year. Okay, so it is still very solid kind of performance. Then the next one we are looking at is Frasers Centrepoint, and this is also a commercial REIT. It has shopping malls, okay, mainly in Singapore. Later we can look at a map for the distribution of the properties. So distribution per unit has been growing 4% per year. You can see there was a dip in 2020. This to me is acceptable because it was a COVID year, and because of the lockdowns and people couldn't go to the malls. There's no point opening the malls anyway, right? So they also extended a lot of the rental relief to the tenants, and the rent collected was also lower. So they decided to delay the distribution of dividends until the situation became better. So when the situation became better in 2021, you can see that the dividend per unit or distribution per unit actually increased, okay, higher than even pre-COVID period. Right, so that's a good sign that the recovery has already happened. And these are the malls of Fraser Centrepoint. You can see the map of Singapore over here. And mainly they are suburban malls, okay, except probably the Tiong Bahru. Okay, actually Tiong Bahru Plaza, you can see is like a city, you can say it's a city fringe. Okay, but other than that, you can see they are usually at the outskirts of Singapore. But to me, actually, Singapore is very small, right? There's no such thing as outskirt or suburb. Is really pretty much a short distance wherever you go. Okay. But that is how they position themselves as suburban malls, kind of a REIT. And some of these suburban malls can be very, very crowded because nowadays, instead of having people go to the city center and you crowd the transport system, there is this decentralization trend over the past 10, 20 years in Singapore, right? So they bring the malls to the neighborhood rather than you having to travel to town whenever you want to buy something else. And if you also realize that almost every tenant in majority of tenants in all these malls, right, are similar. So you can get majority of things that you want to buy from a nearby mall. You don't really need to travel down to the city center to buy stuff, right? So I do think that that makes it a lot more convenient. And I don't know about you, but I do think that a lot of these malls are located in MRT stations, okay? And along the way where people knock off from work, for example, so they may have their dinner there, they may tapao some food, or they may buy some groceries on the way back. Okay, so that increases the footfall because it's so easy, it's along the way. Okay, so I do think that this is an area where they again position themselves very well, right? And they did expanded the portfolio by buying more malls last year or 2 years ago, right? There was a big acquisition from an insurance fund, okay, to buy over some of these suburban malls. Okay, and recently they bought together with the parent company, they bought half of Next, which is in Serangoon, probably around here. Okay, there's another one. They own half of it, right? So Next is also a very popular mall in Singapore. Okay, that is outside of the city center as well. Okay, so this is the debt profile, and you can see that the gearing ratio is quite low at 34%, interest rate at 3.5%. Okay, slightly higher than some of the REITs that we have seen so far. But majority of this debt are fixed interest, and this debt maturity is shorter, right? So this is something that probably not so good in the sense that in these 3 years, 23 to 25, you will see that this REIT need to do a lot of refinancing, and I would believe that that will increase the interest rate further. Okay, so this will also increase their interest expense, and the distribution per unit may not increase as much as what unit holders would hope for. So I do think that that is probably one potential watch area for this Fraser Centrepoint. In terms of share price performance plus dividend gains, 10-year, we are looking at 79% total return and about 6% per year. Okay, again, we are taking at this point in time where the share price have came down, okay, and has not recovered to the pre-COVID numbers yet, right? And the share price has actually gone up in January. Okay, so the returns actually looks better now as compared to just December last year. Next one, Mapletree Logistic. You can see this is the third Mapletree REIT in this list, right? So generally, that's where some of the high quality REITs are. I do note that the Mapletree management get higher compensation, okay, as compared to other REITs. Their management fees are higher. But I do think that based on what we see so far, the performances are also better. So I think good. A fair price to pay for good performance, right? Rather than you pay cheaper price but you get very lousy performances. That's not what a unit holder wants to see, right? So you really want to pay what you get. Okay, so I do think that generally speaking, the Mapletree REITs tend to be of high quality as compared to many other REITs out there. So distribution per unit has grown at 3% per year, right? Pretty steady. Some year there's a slight dip, okay, but it recovers pretty fast after that. So generally, I think it's okay. And as the name suggests, it's really a logistics warehouse kind of property owner. And in contrast to other REITs out there, like Frasers Centrepoint only focus on Singapore, your Mapletree Industrial have half in US, half in Singapore. For Parkway is half in Singapore, 3/4 in Singapore, about 1/4 in Japan. So they are usually are not so geographically diversified. But for Mapletree Logistics, that is the unique part. It is very well diversified geographically. Okay, no matter although it's mainly in Asia, right? But it's in many different Asian countries. Okay, so you have Singapore 21%, you have China plus Hong Kong is about 40%, right? Which is about of it. Okay, but you have Japan, South Korea, Australia, which are also substantial exposure as well. Okay, so it's pretty much diversified as compared to many other REITs out there. Okay, so diversification, of course, have pros and cons, right? The pros is that if anything happened to one particular country, at least is insulated. The rest of the properties are not impacted that much, right? So the overall performance may not be that bad. There's an advantage of diversification. The other probably one disadvantage of being too diversified is that it also mean that the exposure to different kind of problems expands, right? Because they are everywhere, right? So anything happen, they might get bad news as well. Okay. And also that the currency exchanges, right? Because all these countries will use different currency, they will strengthen, weaken. That would cause a lot more forex pressure on the management, and we have to depends on how well they hedge all these currency risk, right? So there's always pros and cons, right? Two sides to a coin for everything that's out there. So for this Mapletree Logistics debt profile, gearing ratio is also low, 37%. Okay, I cannot say low, I should say reasonable, right? Healthy, okay? And interest rate is low at 2.6%, and the percent of fixed debt rate is 83%, one of the highest among this list. Okay? And this is the debt profile. Again, it's pretty much healthy, except for 2024. You can see the bigger due dates are in the later years, and likely by then interest rate will have cut already. Okay, so that is a good sign. Right, you can see that they are in different kind of currency. So which means that when we talk about interest rate, it's not every country treats the interest rate similarly. Okay, and some countries don't even control interest rate, like Singapore inherit the interest rate from the rest of the world. Okay, so that would also depends on what currency debt they are going to refinance. Okay, and then what is the prevailing macroeconomic condition in that country, what's the prevailing interest rate at that point in time. Okay, so with more moving parts, you can tell that it's harder to foresee how would the interest rate impact when they refinance in the future. Okay, so that is one downside of having a lot of different currency exposure. But that aside, you can see the share price still did very well. 10 years performance is 156% or almost 10% per year. Okay, so these are the high quality REITs that we're looking at. Then we have Capital Land Ascenders. This is the only Capital Land. No, sorry, this is one of the two Capital Land REIT that you will see in this list. So this is a industrial REIT as well. Okay, you can see the distribution per unit has grown 1% per year. It's not as strong, right, as what we saw in MIT, okay, Mapletree Industrial Trust. Okay, so relatively, I do think that that's why I say Mapletree tends to be the more well-managed REITs out there. You can see the dip in 21.9, then there's recovery, but it's still not on par at the previous peak of achieved in 21.8. Okay, so there's still some room to grow. And this is the type of industrial property. A lot of them are in business space. Okay, quarter in logistics. The data center exposure is smaller, just 8%. Okay, so it doesn't really command that premium, except probably for life sciences. Also, very specialized kind of properties out there. Okay, so it's quite well diversified. It's not just industrial property. It does have a good part of logistics and a small part in this kind of specialty properties. Okay, and in terms of geography, majority in Singapore. There are some exposure to US, Australia, and Europe. Okay, so they are not so focused on Asia. So sometimes when you look at investing in some of these REITs, right, you can also look at them in totality. Okay, in terms of your geographical exposure. right? So for example, if you decided to buy this Mapletree Logistics, which is predominantly Asia in many countries, right? Because you want a diversification, maybe, right? That's your objective. And you can pair with these capital land ascenders where you have the exposure in the Western countries and including the Australia itself. Okay, so then when you combine together, you get a more geographically diversified REIT portfolio. Okay, so some of this consideration you can factor it in when you try to build a portfolio. Okay, and they haven't released their results yet. Probably in a couple of days. Maybe I think it's probably tomorrow. Right, so you do see that some numbers will be updated tomorrow, right? But based on the latest figures, we are looking at 37% gearing ratio, interest rate of 2.2% is pretty low. Again, high fixed debt rate, and the profile for debt expiring is very even. Okay, so there is no big concern about refinancing. Okay, or what kind of interest rate will they refinance to? Share price gone up 100% in the past 10 years, or about 7.3% per year. Okay, and this is CapitaLand Integrated Commercial Trust. So this is both a retail come an office REIT. Okay, so due to a merger they've done like a few years ago, where they combine or merge CapitaLand Mall Trust and CapitaLand Commercial Trust to form this CapitaLand Integrated Commercial Trust. What a mouthful. Okay. So the distribution per year has grown about 1% per year over the last 10 years. Again, see the COVID impact, and they try to recover from there. This is something different for FCT, right? Frasers Centrepoint, which they already recovered to 2019 figures. Okay, but whereas for CICT, in this case, they have not yet at least. Okay, so until probably the new result come out. Okay, so this is one thing to take note. And this is the composition, right? 30% retail, 40% office, and another 29% is both mix, basically both retail office buildings. Okay, and majority are in Singapore, 93%. Right, so this is a very Singapore focused commercial REIT. Gearing is on the higher side, beyond 40%, closer to 50. I think this is the highest of all the REIT that we've seen so far. Okay, but still much lower than 50%. So not an issue unless the valuation drop a lot. Otherwise, they should not have a chance to even hit the gearing ratio limit. Interest rate of just 2.5%, pretty low as well. High fixed rate, and maturity of his debt is very even between 2023 and 2019. So not a concern. Interest rate risk not as high. This is the performance. Past 10 years, gain 55% or about 4.5% per year, right? So it's one of the weakest that we have seen in this list, okay? But nonetheless, still a consistent dividend grower. And this is what has been affecting the REIT prices. If you have not known by now, US interest rate has been climbing since the start of 2022. Okay, this is end 2022. December. And you can see correspondingly, this is the Singapore REIT index, and the share and the REIT prices have also fallen in tandem. So you can see the non-correlation. Why there is this relation? Why US raise interest rates, Singapore REIT get impacted? Okay, so let me give you a little bit of the macroeconomics that's in this situation. All right, so Singapore doesn't control interest rate. Okay, Singapore controls the exchange rate. Okay, so the central bank will let the interest rate float freely. They will just control the currency strength. So when US raise interest rate, US dollar strengthens and Sing dollar strengthen in tandem. Okay, in fact, Sing dollar strengthened slightly more than US dollar in 2022, such that Sing dollar make a gain. Okay, against the US dollar. And when that happens, we will inherit the US interest rates. Okay, so that's why the Singapore interest rate rose in tandem. But the central bank cannot do anything about this interest rate because the Singapore central bank doesn't control interest rate. It allows free capital flow. It allows it do currency exchange management, which means it cannot control interest rate. So in economics, there's this theory called the impossible trinity. So you cannot do all three. No country can do all three together. So for US, they control interest rate, they allow free capital flow, they cannot do currency exchange management, right? So they have to let US dollar float freely. Okay, so you can see that every country, the policy is a bit different. That would cause the impact to the markets slightly different, right? So you have to understand what's the relationship. So when US raise interest rate, Singapore, because your benchmark against US dollar as one of the key currencies out there, they will inherit the interest rate from the United States of America, right? So that's the relationship. So when this interest rate goes up, the Singapore REITs, they will borrow in Sing dollar, right? And some of them, they have foreign currency exposure, as we have discussed so far, but majority of them probably have Sing dollar exposure. So with Sing dollar exposure, interest rate goes up, the cost of financing goes up. Okay, the more interest they need to pay. And because all these REITs, they borrow money to buy properties, right? So the interest rate goes up. Okay, but that's why we talk about those REITs with higher percentage of fixed rates. They are less affected by these interest rate hikes. Those that have a lot more variable rates, then they get impacted. So it's not just the REITs, but also individual home buyers who borrowed money to finance their houses. Those that are on variable rates have seen the interest payment gone up over the past 1 year. Okay, so when those interest rate goes up, which means that the profits at the end of the day will be lower. And when profits is lower, and hence it will impact the dividends, the dividend will go down. And when dividends go down, the dividend yield will go down. And when dividend yield go down, the share price have to go down further in order for the yield to recover back up. Okay, and especially if you think about it, right? If the Singapore government bond, okay, or the bill was giving like 4%, why would someone want to buy a REIT if it's at 4% dividend yield, right? Because the bond would be more risk-free. Okay, people flock to the bonds. And that was exactly what happened in the past few months. And then that will lead to the dumping of these REIT prices. Okay, because people sell the REITs and they will buy the bills or the bonds. And that causes the REIT prices to fall. And when the REIT prices fall enough, it can become attractive. Let's say the REIT is paying like 8% compared to the bill is still like, wow, double, right? So then you attract some of the investors back again. Okay, so that is how the markets move as well, right? It does, all this interest rate environment does affect a lot of things. Okay, as you can see, it's a cascading effect. One leads to another, leads to another, leads to another. Okay, so if you are able to understand the mechanism behind all these relationship between all these different assets, you will be able to see the picture clearer. You'll be able to assess the situation and make a better investment decision. Okay, so then how do you tell whether a REIT is it worth buying at this point in time? So I want to introduce you to this concept where you compare the Singapore 10-year bond yield versus the overall REIT yield. Okay, so logically, because the Singapore government bond is risk-free, okay, so your REIT yield must be higher than the bond yield. Makes sense, right? Because if you buy the REIT, you're taking higher risk than if you bought the bond. And the yield spread, okay, the difference between the REIT yield and the bond yield in the past 10 years, on average, is about 382 basis points or 3.82%. In other words, your REIT should be trading 3.82% above the 10-year bond yield. Okay, then you know that this is a fair price to buy for this REIT. Okay, so that is how we can use this method to assess when to buy a REIT. When is it a good deal to buy? And of course, the dividend yield, we're not looking at the historical yield, we're looking at a forward yield, which means that it's projecting 1 year ahead. Okay, and how do you get this number? Usually a lot of analyst report will provide this, and you can just compare this forward yield with this yield spread plus 10-year bond yield. Okay, I'll do a calculation for you so that you understand what I'm trying to say. So currently the Singapore 10-year bond yield is at almost 3%, 2.97%. Okay, and we know the yield spread in the past 10 years has been averaging at 3.82%. So you add these two together, you will get about 6.8% around there. Okay, so in other words, a REIT should minimally trade at 6.8%, give you a 6.8% yield before you buy it. Higher, better. Okay, all things being equal, but of course, we understand that not all REITs are of equal quality. So REITs of poorer quality, they should give you a higher yield because they're taking more risk. That's essentially how the market prices these REITs as well, right? It doesn't mean that a 10% yielding REIT is more worthwhile than say a 6% yielding REIT. Okay, because the 10% yielding REIT may possess certain risk that the 6% REIT doesn't have. Okay, so you're actually compensated with taking the additional risk. Okay, the market is pretty fair, right? The market is not stupid. Right? They do price in some of the risks that are unknown. And so when we look at the high quality REITs, we talk about the 7 high quality REITs today. They have usually rising dividend distribution per unit. Their debt level is healthy. Their debt profile is well distributed. And which means that you may not need to use this very stringent 3.2% because this 3.2%, right, includes good REIT, bad REIT, lousy REIT, normal REIT, average REIT. So it's a bunch of REITs. Okay, so if you just want to focus on buying a high quality REITs, you can give a bit of discount. So in this case, I only take 70%, which means I give about 30% discount to the yield spread. So, and I add on top of this 10-year bond yield, I'll get about 5.6%. So if a high quality REIT, which I qualify, the 7 of them in this list, if they are trading above 5.6%, then it makes sense to buy. Okay, so that is one perspective, how you can know whether REIT is trading at a good, reasonable price for you to enter. So I have also compiled the forward yield of these 7 REITs that we have discussed so far. And because their share price have gone up, okay, if I've done this presentation a month ago, you will see more REIT passing this criteria. But because the REIT prices have ran up quite a fair bit in the past 1 month, now we only got one that's trading above 5.6%. Okay, which is only Mapletree Industrial, which is also not very high above, right? Just 5.6%. And you can see the rest are all below. Okay, so you might want to use this as a consideration, right? Use this as a benchmark. Of course, you may even have your own way to evaluate whether a REIT is worth buying. Okay, but this is one of the ways that I want to share with you. Okay, because this is quite dynamic. Your bond yield will fluctuate, right? Because if interest rate goes up, this bond yield will go up. If this bond yield go up, you will demand more yield from the REITs. Okay, so it is dynamic in a sense. It helps you adjust if rates increase further. Okay, so that's what I like about this method itself. Okay, so in summary, we talk about high quality REITs today, and one of the key considerations is that they have consistent distribution per unit growth over a long period of time. That's a track record that we're talking about. And this track record, right, can only be achieved if they have great properties, okay, underlying properties that they can increase rent without chasing away tenants. And it has good management. They make good acquisition decision that increase the yield, right? Yield accretive acquisition. They do asset enhancement to increase the value of their existing properties. They maybe edge out more units to rent out, increase the property income, right? They manage the expenses well. Okay, so these are all baked into consistent DPU growth kind of factors. And we talk about 7 of them today, right? Not in order of merits. We do see quite a number of Mapletree trusts, right? The logistic and the industrial. We saw 2 capital land, Ascenders and integrated commercial. The capital lands are the weaker ones relatively. As you can see the numbers I showed you just now. There's another mall, which is a Frasers Centrepoint, and a unique one would be the hospital, right? Which is also the most expensive. You can see the yield is only 3.7%. It's really very low. It is the investors who are early in this REIT really make a lot more. Okay, currently at 3.7% yield is a tad expensive in my view. Okay, but it's not without reason because the hospital properties are very unique, very specialized, and have very long lease, okay, in the decades. Okay, so they are pretty stable in their performance. And we also shared about how to know whether a REIT is worth buying. I introduced you the concept with this minimum acceptable yield, where you add the yield spread, okay, because a REIT must trade above the bond yield, and add it to the Singapore 10-year bond yield to get the spread. Okay, and I also share with you that these high quality REITs, they usually will trade at a premium, and it is also logical that you should give a discount to this bond yield spread, which consists of low quality REITs as well, right? So I gave a 30% discount, so that's how I ended up with a minimum yield requirement of 5.6%. But also remember that this yield may change. Okay, this Singapore bond yield may change, and you will change your minimum yield. Right, so this you can just check from the internet. On a daily basis, this number will change. Okay, and it's very sensitive to how the US raise the rates. Okay, so if US raise the rate tonight, you will expect this 10-year bond yield to go up in Singapore too. Right, so that is how you can picture the whole things together. So I hope you get a better idea how to evaluate REITs. Okay, so my sharing will end here today, and we will have another session that will be coming up. One in Mandarin that is on 20th Feb. Okay, and another one that will be doing. I haven't set a date yet, likely in March, which is in English. Okay, it's likely the same topic. So thank you today for coming for this session. I hope it has been useful for you, and I hope that 2023 is a much better year for the markets, not just for you and me, but for everybody, right? And stay safe, happy investing, make more money, and happy new year. Goodbye.